Welcome to our High Rock monthly video for February. Today, we shall address how financial markets performed last month and the implications for your portfolios in the near term, any key adjustments to our models and special mandates, and how managing risk first and how that philosophy will be the key to maintaining growth in uncertain times. And Paul, we are definitely in some uncertain times, are we not?
Are we ever? We've seen this movie before about 4 to 8 years ago.
I am Scott Tomlinson, and with me on the call, as you just heard, is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are approaching our 10-year anniversary. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Paul, let's quickly revisit January, which saw most financial markets growing positively, other than real estate investment trusts, which, as you've mentioned in the past, are somewhat a function of what's going on with interest rates, but perhaps also as a result of economic circumstances as well.
Yeah, and obviously, we don't own any REITs, and there are a couple reasons why, because I think they underestimate their capital expenditures, but that's a different story. Work I had done years ago. Gold and silver being the highlight. Gold is hitting new highs, it seems like every day. And silver is extremely volatile. We do own a bit of both, and for those that aren't aware, we own more gold than silver in most client accounts, and we own physical gold and silver that is stored and held at the Royal Canadian Mint in Ottawa. So we don't own like ETFs that own futures and options and all kinds of derivative products. We actually own physical gold and silver.
That's a great update, and also it was a good month, basically for most other equity assets and preferred shares, as well as positive month for bonds, even though it was small. That's been helping balance portfolios as we speak. Another aspect of financial markets has been the Canadian dollar. Paul, I'll let you talk a little bit about that, but for the most part, it has obviously been quite volatile since the U.S. announced tariffs on Mexico and Canada and China, and have threatened the rest of the world with tariffs. So certainly that's presenting volatility for the Canadian dollar and other currencies.
Yeah, I mean, just across the month of January, we were pretty much flat. Now, from December into January, which I know was the previous month, that's where the Canadian dollar gave up some ground. The post-Trump victory and talk of tariffs, talk of 51st state, etc. That kind of weakened the currency up from, well, you've got it inverse, but from 140 to 143, and we saw it there for the month of January. But on February 3rd, walking in here after the tariffs came through on Saturday, that currency had pretty much a 500 pip move, what we would call. So went from basically 143 up to 148 during the course of the day, and right back down to 143-ish. So extreme volatility in the currency. And there may be more to come. I fear that the currency may move towards testing its all-time weak point, which again in the US dollar versus Canada would be up around 162. And just another, the reason why we do own about most of our clients' balanced portfolios own about 20% in US dollars. So we own some securities in US dollars directly, and that gives us a natural hedge when typically when markets go to hell in a handbasket, the US dollar strengthens. So it is a natural hedge to the rest of our portfolio.
And that's part of how we mitigate risk in a lot of ways when there is significant uncertainty that moves investors out of risky assets into safer assets, the US dollar tends to benefit, and owning US dollar assets certainly helps to mitigate the downside to that uncertainty. We'll talk a little bit more about the risk factors in portfolios in just a second, but that's something worth considering. Another thing, and for those of you who are thinking of traveling or are south of the border for the winter, um, we've had these conversations directly, but again, always think about having a US dollar account and having a US credit card, because we have US assets that are always generating cash, and in your non-registered accounts, we can send you some of that cash so that you don't have to make conversions when the currency gets expensive. And if you're using US dollars to travel, then it might be wise to think about getting in touch with us to talk about the options for getting some US dollars into a US dollar bank account, and perhaps having a US credit card with which to avoid the currency um, transactions that banks and credit card companies tend to um, uh, propose userous rates of.
I thought I was gonna intervene there and say gouge your eyes out.
Yeah, that I'm being a little bit more less dramatic perhaps, but still, it is something that you want to be very careful of, and if we can help, then even better. Moving on, we try to focus on longer term returns. 1 year returns are great, but what is your portfolio, or what have returns been doing over longer periods of time on average? We look at the Morningstar Global Neutral Balance category as a bit of a comparison. Again, each client portfolio is going to be balanced according to their specific strategy, but here's a something to look at and make comparisons with your specific portfolio. So most of you will have received or will receive your quarterly update if you've been with us for 3 or 5 years. Certainly make comparisons of your returns to these returns. And if you have any questions or concerns, bring them to our attention, please, because that's what we want to make sure you understand, how we are getting these longer term returns and what we're doing to do so. And one of the things that we talked about a little bit last time was the risk factors that we look at, and that in many cases is something called standard deviation, and that's just what happens if there's a one standard deviation move from the mean, up or down. But we worry about the down more than we worry about the up. The up is what we expect, the down is the risk. And if the average 5 year standard deviation in a balanced portfolio is somewhere in the vicinity of 9.5, that means that your $100,000 portfolio is vulnerable to lose almost $10,000 in a one standard deviation move down. So that standard deviation is very important to us as we manage risk. Most of our clients, if you ask us, they've got somewhere between 7 and 8 standard deviations. So the lower the standard deviation, certainly the less risk your portfolio contains. And then we want to look at that in terms of returns. So if you're getting as well, the average will suggest a 5.67 5 year annualized return, and the standard deviation is 9.35, you're getting 0.56% return relative to the risk that you're taking. What's really important is we want that number to be higher, and I think most of our clients are up closer to 0.8, and I think that's something that anytime that you want to have that conversation about your specific portfolio, please don't hesitate to get in touch. I don't know if you have any comments there, Paul.
I would just add first two things. First of all, just make sure people watching the video, these are not your client or our client returns. This is just from Morningstar data, just for illustrative purposes, number one. Number two, it's very important when you're looking at not only your own returns or somebody is marketing you returns, which we don't do. At High Rock, we don't show an actual client return. We just use these broad Morningstar returns. But if somebody's talking to you about returns, the most important thing is what kind of risk they took to get that return. And that's where that Scott's showing the 5-year return per unit of risk. That's the most important thing. You got to compare apples to apples. You can't compare, owning the 10 big mega cap stocks in the US versus having a balanced portfolio. They're not the same. They're not the same in return, and they're not the same in risk, and therefore return per unit of risk. So you need to make sure you're comparing apples to apples. That's all.
And as we head into more uncertain times, fully understanding the risk that your portfolio is vulnerable to is pretty important. Paul, do you want to talk about the special mandates? Paul, if you're talking, you're on mute.
I was talking and I was on mute. I'll talk about the pref mandate first. We did, as well as our balance mandates, our last bank preferred share, commerce.p as in Peter, was redeemed January 31st. So that came out, went into cash. We didn't, in the pref mandate, we didn't really have any, we did a little bit of buying in some what are called perpetuals. So they do better when interest rates decrease. We just added on a little bit there, but not a lot of activity. The mandates still perform quite well, and a lot of that is based on two things. Such reduced supply in the pref market because of all these bank redemptions, and other corporates have redeemed some preferreds. So it's sort of a supply-demand issue that's driven the market to this performance. But on the other side of that, my valuation model is some of these are getting a little bit rich for my liking. So we're just going to sit. We are long some cash, and we're going to try and sit and be patient. The high yield mandate performed quite
Paul,
well.
sorry, just to jump in for a second.
Yeah.
When we say you're long cash, you're actually long cash equivalent, so a high interest savings fund that currently is somewhere in the vicinity of a 3% annualized return, I believe.
That is correct. When we say cash, Diane typically puts the cash in overnight HISA, a high interest savings account. So it's overnight. We can get the money back the next day. We have to roll it every day. So yes, it's still earning income for us. High yield, that performed pretty well. Interestingly, and we do have a pretty big weight in energy. In fact, we added a bond, an oil and mostly oil producer, a small one, at an 11% yield. And I was thrilled to get what I got because it was highly spoken for by two very large clients that bought the bulk of it. So that went into our high yield mandates, and it replaced Source Energy, which everybody owned, both balanced and high yield. That was redeemed January 20th. So that was pretty good for the high yield folks. That replaced a high coupon with another high coupon. And it performed well. What I was going to say, Scott, interestingly, is these energy bonds they have phenomenal what I would call credit metrics, but balance sheets. They have very, very strong balance sheets. They don't have a lot of leverage or debt versus the amount of cash flow they have. So they've performed well, whereas some of their underlying equities are way more volatile, as one would expect, but have not performed all that well over the past month even. That's it for those special mandates, Scott.
All right. And I'll just remind everybody that our focus is really on your long-term goals, and it's very important to stay in touch and to update your wealth forecasts and any changes to your lifestyle situation. And we want to be able to certainly help you to prepare for your cash flow needs as you move forward into future years. And so it's what we do. We did see the Bank of Canada drop rates by 25 basis points on the 29th of January. And at the same time, on the same day, the US Federal Reserve held rates steady. Two different economies at this stage, perhaps allowing inflation maybe a little bit doing a little better in Canada and not as well in the United States. So we'll keep our eyes on how that moves forward. Obviously, the tariff situation is certainly going to be impactful, and both central banks are definitely watching those situations closely. Global equity strategy, we still think that most equities are at a fairly high value. So we're not looking to add anything specifically at the moment when it comes to rebalancing. We're holding our strategy fairly steady. We don't mind having a little bit of extra cash or cash equivalent in the global equity model for potential opportunities as they may come along. But at the moment, we're fairly quiet, other than the natural rebalancings for cash flow purposes. Tactical strategy, Paul?
Yeah, tactical. I mentioned earlier about energy bonds and their underlying stocks. So they've not done, our energy positions and equities have not done all that well through January. So I still think they have nothing's changed other than they are extremely volatile. Certainly, two of them that we own. But there were no other real changes in the month of January to our positions. That's the only observation, Scott.
Thank you. And fixed income?
Fixed income. I already mentioned preferred shares in the top left pie chart. The commerce.ps were redeemed January 31st. And we had a huge wait for the past year in preferred shares. In some cases, it was, most clients were double our model weight, how we would normally, or the amount we would normally carry in preferred shares, or carry rather. So now we're back down to about our model weight, maybe even a snick under. Again, just because I think the market is a bit rich right now, and we will look to add a little bit should there be some weakness. We'll just keep going around. Government bonds across the month, say 5-year Canada's as an example, rallied, i.e. went 20 basis points or 0.2% lower in yield. So the price went up. So they were actually, they helped the model a bit. Investment grade helped the model a bit because of the decline in interest rates, but the spreads actually widened out a bit, so they didn't get the full benefit. High yield bonds, as I mentioned earlier, performed quite well. They had a good month. Again, most of those being the energy bonds. That is about it.
All right, thank you. And now I'm going to move into a little bit of admin stuff because it's tax time coming. And I know that clients like to get their tax houses in order as soon as they possibly can. And here I come to burst your bubble a little bit because as you will see, there are some documents that don't arrive till after the end of March. And it is very important that you don't file prior to receiving those documents, because if you have to go back, your accountant will not be thrilled. So let me walk you quickly through. If you're on our website, you can log into your Raymond James accounts through that. Then you can go to the My Documents area to find your tax documents. And then from there, you can look for your specific what your needs are in so far as that is concerned. But one of the things that you will want to look at is the calendar for some of these documents, and that's what I was talking about. your T3s, they come, usually they have to be mailed by March 31st, so they may come after March 31st. So you don't want to be filing before you receive these documents, and they don't come from Raymond James. They come from the specific company. In most cases, it's Manulife, because it's the Manulife high interest savings fund that we use. So it comes from them. So you'll have to be a little bit patient. I'm sorry to have to tell you that. However, if you have any questions, or if you need to update your login, please don't hesitate to get in touch with us. We're happy to facilitate you getting online so you can get your documents as soon as they are available for you. All right, and that's it. We are happy and thankful that you're able to take the time once a month to go through this. I think there's some important information for everybody here, but we will again be back at the beginning of March to update you further. And until then, we wish you all the very best.